Investing can feel, well, just chaotic, right? You've got news flying at you, opinions from every corner, and your own emotions just pulling you all over the place. But what if there was a system, a disciplined, data-driven approach built by a market legend who actually studied what works? Okay, let's dive into it. This quote from William O'Neill, the creator of the CANSLIM system, really gets to the heart of his whole philosophy. See, it's not just about picking the next big winner, it's about managing your risk so that you can control your emotions and, well, actually sleep at night. Discipline in his world is everything. So here's our game plan. First, we're going to look at the thinking behind this whole method. Then, we'll unpack that CANSLIM acronym piece by piece. First, the company fundamentals, then the market timing. After that, we hit what might be the most crucial part, managing your risk. And finally, we'll see how it all clicks together. To really get the system, you've got to understand the man behind it. We're talking about William O'Neill, the founder of Investors Business Daily. Now, he didn't just guess what worked. He did this massive historical deep dive, analyzing the common traits of the biggest winning stocks all the way back to the 1800s. And what he found was incredible. The super performers, the Teslas, the Amazons, the Apples of their day, they all consistently shared 7 key characteristics before they went on those huge runs. CANSLIM is just a simple acronym for those 7 traits. Think of it like a toolkit, a repeatable process, not just a bunch of hot tips. Really, the best way to think about it is like you're counting cards in blackjack. You're not trying to predict the future with a crystal ball. You're just using a data-backed method to figure out when the odds have shifted dramatically in your favor. It's all about probability, not prophecy. All right, let's start building this out, starting with the first 3 letters, C, A, and N. These are all about the company's fundamentals. They basically answer the question, is this a healthy, growing business with a powerful story behind it? This is the engine, the fuel for a stock's potential. So C stands for current quarterly earnings. And O'Neill wasn't looking for little single-digit gains. He wanted explosive, massive growth. We're talking a huge jump in a company's earnings per share compared to the same quarter from the year before. And that comparison is key, right? Because it filters out any seasonal weirdness in the business. Now, check this out. This number should really make your ears perk up. O'Neill's research showed that the biggest stock market winners had, on average, earnings growth of 70% or more in the quarter right before they took off. So the lesson is clear. Huge price moves are very often preceded by huge profit moves. And if you want to see what that looks like in the wild, well, here you go. Just look at Tesla before its epic run in 2020. I mean, 140%, 300%, 95%. These aren't just good numbers. These are screaming signals that a company is hitting a massive growth spurt. Next up is A for annual earnings growth. Okay, so one great quarter is awesome, but it could be a fluke, right? That's where A comes in. O'Neill wanted to see a consistent track record. He looked for companies with at least 3 straight years of solid annual earnings growth, ideally above 25% each year. This shows you the company has a real, durable business, not just a one-hit wonder. N is for new. And this is the catalyst. It's the story that gives the numbers their power. What's driving all that growth? Is it a revolutionary new product, like when the first iPhone came out? Is there a new visionary CEO shaking things up? Or, hey, is the stock itself just hitting brand new price highs? That's a powerful sign of strength. The N is the story. Okay, so you've found a great company using the CAN fundamentals. Awesome. Are we done? Not even close. The second half of the acronym, SLIM, is all about timing and context. It answers the critical question, is now the right time to buy this great company? S stands for supply and demand. Now, originally, this was about finding companies with a smaller number of shares out there, which can lead to really explosive moves. A more modern way to look at it, though, is through trading volume. When you see a huge, massive spike in volume as a stock is rising, that is a clear sign of big demand. It tells you the big money players, the institutions, are getting in. L is for leader or laggard, and this one is absolutely critical. O'Neill's research was crystal clear. Buy the best performing stocks in the strongest industries. Don't go bargain hunting for the number 3 player in a hot sector, hoping it'll catch up. No, buy the leader. The key metric here is relative strength, which just shows you how a stock is performing against the rest of the market. You want the ones that are already winning the race. Next up is I for institutional sponsorship, and the analogy here is just perfect.
Think of big mutual funds, pension funds, hedge funds. Think of them as elephants. When they decide to buy a stock, it's like an elephant jumping into a bathtub. The water level, the stock price, it has to rise. It's their immense buying pressure that really fuels those major uptrends.
You want to see the elephant show up? Here's what it looks like. Look at the number of funds that owned Zoom. It went from under 300 to over 1,400 in less than 2 years. That is a whole herd of elephants jumping into that bathtub, and it's a huge reason the stock made such an incredible move. You want to see this number going up over time. And finally, we get to M for market direction. And I'm telling you, O'Neill would say if you get this one wrong, literally nothing else we've talked about matters. His research showed that 3 out of every 4 stocks, even the very best ones, will get pulled down in a bear market. So the point is, you have to have the wind of a market uptrend at your back. You can't fight the tide.
And O'Neill didn't just say, hey, follow the market. He gave us specific quantitative signals to watch for. He looked for something called a follow-through day, a powerful surge on a major index that basically confirms a new uptrend is for real. It's like the market giving the green light. On the flip side, he watched for clusters of distribution days, days where the market closes down on heavy volume. That's a warning sign the big institutions are quietly selling.
Okay, so we've gone through the whole acronym, but picking the stock, honestly, that's the fun part, the easy part. The single most important piece of this entire system, the thing that separates long-term winners from those who blow up, is disciplined risk management.
So let me ask you a question, a little mental math. If your investment drops by 50%, what percentage gain do you need just to get back to where you started? The answer might really surprise you. Take a look at this. This is, well, it's the brutal, sobering math of investing. A 10% loss needs an 11% gain to recover. Okay, manageable. A 25% loss means a 33% gain. Getting tougher. But a 50% loss? You need a 100% gain. You have to double your remaining money just to break even. This is exactly why letting a small loss turn into a big one is the cardinal sin of investing. And that math brings us to O'Neill's unbreakable, non-negotiable golden rule. And honestly, it's the hardest part to follow. Always, always cut your losses at a maximum of 7 to 8% below what you paid. No questions asked. It's painful to take a loss, I get it. Our brains are wired to hope it'll come back, but O'Neill was so clear on this. This isn't an emotional decision, it's a mathematical one. Honoring this rule, with 0 exceptions, is what protects your capital so you can live to invest another day. So we've looked at all the individual pieces of the puzzle. Let's finish up by seeing how they all fit together to create a clear, top-down process. Something that turns all that market chaos into a structured framework. The best way to visualize the whole process is to think about those Russian nesting dolls. You always start with the biggest doll first, the overall market direction, the M. Is the market in a confirmed uptrend? If the answer is yes, then you open it up to find the next doll, the leading sectors and industry groups, the L. And only then, once you've gotten those big things right, do you look inside for the smallest doll, the individual stock, with all those powerful CANSLIM characteristics. Ultimately, CANSLIM is really a challenge to every single one of us as investors. It forces you to look in the mirror and ask a tough question. Am I making my decisions based on a proven, repeatable system with a strict set of rules? Or am I just kind of winging it, operating on emotion, hot tips, and hope? The answer to that question can make all the difference in the world.